we're in a rising rate environment.
Yep.
There's any amount of debate you like over how quickly the Fed is going to hike rates, how many rate hikes there'll be this year, and how the Fed may respond to flickers of inflation if they present themselves.
Right.
One thing you'll be able to see much sooner than that is if the 10-year Treasury yield crosses 3%. It's at 2.94 right now. How important is that threshold?
Oh, absolutely. The first thing I did today when I came into the conference was go right up to the Bloomberg terminal and not look at the equity market, but look at the bond yield curve. I'm very concerned about it's eventually going to go through that 303 level. That's a critical level, but it's very important to watch when it does, and especially that 10 to 30 flat part of the curve. We're getting to a flattening. We could go inverted. Doesn't always mean automatically we'll have a recession within 12 months, but it lends itself that way. So all investors really, the equity market needs to finally be looking at the bond market like it always used to be. The bond market's going to take the lead, and that's where I think we've got to get our indications.
Do you agree, Chris, with those who say that 3 or 303 is the beginning of a bond bear market?
I think we're actually in a bond bear market. I think that if you look, there's a 30-year channel, which rates have been dropping. We have hit the bottom, and we are bouncing and building that bottom base. So I think we're in a long-term period, no surprise where rates are going to rise, which is a bear market. But you got to realize a bond bear market is not like an equity bear market. You're not going to drop 20 or 25%. You're just going to have lousy returns, -5, -2, +3, which is a normal bear market for bonds coming back up in a rising rate environment.
But what if investors are caught offside the way they were in 1994? It could be worse than -2. It could be worse than -5.
I remember 94 like it was yesterday. But that was the surprise from Greenspan, where he raised rates 75 basis points in one meeting. We've got a dot plot. We've got more forward forecast out of the Fed. So I think, in terms of investors being caught off guard, yeah, mom and pop are moving into bond funds because they want the yield. And I've been trying to advise, particularly our retirees, don't just run into long maturity fixed income. Be in credit, be in other securities, and pay attention to the shorter part of the curve because they want yield. So if you're yield hungry, you could get caught off sides, but we know rates are going to go up. They need to. The Federal Reserve built up that giant balance sheet after 2008, and it needs to unwind it slowly.
Chris, what do higher rates and higher yields mean for you as a pension fund manager trying to hit your 7% annual return target?
Well, I'd actually say that's better for me because I finally earned some money on my cash, on my fixed income. I think it better prices in risk assets. The zero rate environment has made risk almost free to many people, and so we're not getting that good pricing. So to me, I would rather see rates get back to what the Fed considers normal, which somehow is around 3.5. I think normal is closer to 4 or 5, but it'll take a long time to get back there. So I think it's actually good news. We're in this low rate environment, but I've been averaging about 7-8% over the last decade. I'm okay with that.
There are negative aspects to it, of course.
Oh, yeah.
Any fixed rate debt that you have now is going to be worth less, almost by definition. And it raises questions about the sustainability of the equity market.
Well, in terms of, I think the equity market, when I think of sustainability, Eric, I'm thinking, 30 years. In terms of sustainability of this equity rally, yes, I think it's run out of steam. It's remarkable it's lasted this long. January, to me, was kind of that classic just peak up, and the market ran out of steam in February. 2018 is going to be a tough year. Doesn't mean we have to have a recession, doesn't mean we have to have a classic bear market. We could have a 2016 where the market's kind of sideways. The roller coaster. You start at one point, you go up and down, you end at the same point.
As an institution, when you change allocations, you don't tend to do it in big ways. But tell me how you're thinking about changing the CalSTRS allocation going forward. Are we going to have less equities? Are we going to have more alternatives? What are you going to do about fixed income?
We're a giant cruise ship. And my board gives me a rate and return to aim for. The chairman of the investment committee is right behind me. He's telling me where to head for the horizon. But the horizon keeps extending. I'm never coming to port. So the answer to your question is, I'm going to make subtle corrections, course corrections along the way. I can't spin this ship on a dime. I'm not a ski boat. So I'm going to make subtle changes to the asset allocation. We do want to take a little bit down in equities. We're at 55%. We probably want to get to about 48 over time, and diversify the assets in other alternative investments, long-term investments, real estate, private equity, infrastructure. Prices aren't great right now, but over the next 5 to 10 years, we think there'll be plenty of opportunities.
Specifically on equities, going from 55 down to 48 is not an insignificant amount of money. That's about $15 billion.
Yeah, no, it's a big chunk of money. But also remember, we're global. So we're not just in the USA. I'm not casting out a sell signal. We're going to make this change over the next 5 years. People won't even notice. I can move $1 billion around and not create any wake in the market.
Chris, one of the things that you've had to wrestle with on the corporate governance front is the question over gun control.
Yep.
And whether an organization like CalSTRS should be responsive to the concerns that your members, teachers, current and retired, have over gun ownership and the use of guns in America. We've talked about this before. Has your thinking evolved on the need or not to isolate and exclude exposure to guns in some of your portfolios, including your indexed equity portfolio?
Well, and I want to be clear, it's not just guns. It's really the focus is on those military-style weapons, assault weapons, whatever the definition. There are certain kinds of firearms that are illegal in the state of California, mostly things that are rapid fire or what I call black guns, those military-style guns.
AR-15s, for example.
We divested of those in 2013. So we're out of the Strum & Ruger and Smith & Wesson. We finally got out of Remington as a private equity investment. And now what we're really focusing in on are the retailers. So our board is going to meet next week. There's a proposal from our chairman to move assault weapons right up to the top of our corporate governance engagement, to meet with retailers to talk about their reputation. Do they want to be associated with this kind of thing? And I think you're already seeing that reaction in corporate America, where they're stepping up. I was here with the CEO of Kroger's, where they realized they don't even want to sell firearms in Fred Meyer's. They've got other products they'd rather diversify. We're going to talk to Walmart. We'll talk to Dick's Sporting Goods. We'll talk to Sportsman's Warehouse.
Chris, you're not afraid to be outspoken. You've taken a stand on this issue. Your fund took a stand on the use of smartphones and other electronic devices, and how encouraging Apple to take a hard look at it. You yourself said you deleted your Facebook account not so long ago. What are your corporate governance priorities, either the ones that are set for you or the ones that you're promoting to your own board?
Well, our board sets our corporate governance priorities in November, right before we get into proxy season. Diversity is always critical. Gender and ethnic diversity. Climate change is a huge issue. Those aren't going to go away. But more topical issues like the FANG stocks, particularly with Apple and the use of their products and how it impacts kids, we're a long-term investor. We're going to own Apple as long as they're public school teachers in this state. We're going to own Apple. We've owned Apple since the 80s, before the iPhone, and it took off. So we care. We want to have a dialogue with management. How do you operate this company? I could care less about the next 91 days. What I care about are the next 91 years. I want to know how they're going to do 10 years from now and 20 years, and operate with a long-term view.